everybody, and welcome to our discussion on the history of accounting standard setting. So for the first few slides, we're going to talk about just accounting in general, some of the history with accounting itself before we get into some of the standards, and we even move on to auditing standards toward the end. So when we talk about the history of accounting, when in world history has accounting been used, we can look back about 7,000 years, which obviously seems like quite a while. And here we're talking about ancient Mesopotamia. Now, obviously, back then the accounting was extremely basic, extremely rudimentary. Those earliest pieces of evidence were basically showing that accounting was used for tracking crops, tracking herds. So extremely basic. Later on, it evolved as we get closer to the Roman Empire, and obviously beyond that, because then we start having actual money. Taxes are a big thing. We have all of that. We start to see kind of forms of investment into companies similar to corporations types of things. So yes, we have accounting there, still very rudimentary, but at least it set the stage for what comes later and today. The first time we can actually see a system that would look somewhat recognizable to us today is in 1494 with really the introduction of the double entry bookkeeping system. I don't want to say the invention or the creation of the bookkeeping system, double entry bookkeeping system, because that actually happened about 50 years prior. But in 1494, it's an important year because Luca Pacioli, also known as sometimes known as the father of accounting, he put together all the information at that point that was available on accounting, including the double entry bookkeeping system, into a 27-page essay, and it was the translated title is Details of Calculation and Recording. Of course, it was Italian, so it had an Italian title to it. He was an Italian mathematician. But the important thing here is that this textbook discussed what double entry accounting was, why it was important, and we use this model still to today. The idea here with double entry accounting is that every transaction has at least two pieces, it impacts at least two accounts, and they have to balance out. So the thought here is, just as an example, if one account increases, what caused that increase, or what was caused by that increase? Just a quick example here, if your cash increases, okay, that's nice, but why? You might find out, well, we borrowed money, so now we owe more money. There's a liability. Or, well, we earned revenue, so now we have more revenue on our books. So you can see just briefly how the two relate. It's important to have two accounts, at least two accounts, so they can explain. So now we're starting to move forward to the actual accounting standard setting. Now, again, we started in 1494. And there were very few rules, if you want to call them that, and they were very informal at that time. Obviously, the U.S. was not even in existence at that time, but you move forward a few hundred years. Other countries were using accounting for various purposes. Corporations, even though they were an earlier form of corporation, they've existed for quite some time. By corporation, I'm talking some external investor investing money into this group, so to speak, this company, and sharing the risk and rewards of that. So the problem with that, with a corporation, is that you have external investors that they want to know information about the company. You might also have creditors. They want to know how the company's doing, so they rely on some sort of information from those managers, the board. They're developed based on accounting information. So now the question is, how trustworthy is that information? And we found out right around 1929 with the stock market crash, which obviously in part led to the Great Depression. But the thought here, the big concern at that time, was that after everybody was thinking their investments were doing fine, they thought they were being told the truth, and they found out that's not always the case. So there's always a concern about investors and creditors feeling like they cannot trust the information given to them. And the concern is that if that's the case, if that fear grows, they will stop investing, they will stop lending, it'll freeze the capital markets, companies won't be able to grow, or some of them won't be able to even start up. So this is what led to the first modern standards created around 1932. Right around that time, we have the Securities Exchange Commission, a government agency established. Now, generally speaking, even to this day, the SEC has the overall authority to set accounting standards, but historically they have not. They've delegated that. Every now and then they'll step in for certain things, and we'll talk about one of them later on. But generally they've delegated it to other areas with more expertise in the field and more independence. They want a non-governmental agency involved. So the first real, true standards we have come about 1932 to 1934. We have what's known as the American Institute of Accountants, which is the predecessor to the American Institute of Certified Public Accountants that we have today, the AICPA. And at that point, they set 5 broad principles. Very broad, not really specific rules at that point, but at least we had something. So if we start off on 1939 to 1959, we have our first real committee. The Committee on Accounting Procedures, the CAP. The important thing to note here, they are a committee within that American Institute of Accountants, what we know today as the AICPA. So what this really means is the accountants and their professional organization, they're setting standards for themselves. That's self-regulation, self-government. There's a little bit of a concern with that, and we'll discuss that later on. It's all an appearance of independence and integrity, things like that. So this CAP, in 20 years, set just 51 accounting research bulletins. The first real, true type of GAAP, generally accepted accounting principles. If we move forward a little bit, we have 1959 to 1973. We have the Accounting Principles Board, APB, but you know what? They're also another arm of the AICPA, so you just renamed them essentially. Gave them a slightly different purpose, but it's still the same thing, set principles. They had 39 APB opinions on accounting issues. In 1973, this is the board we have to this day. The Financial Accounting Standards Board, the FASB. Now they're a board. The big difference here, because that self-regulation concern I talked about, the big difference here is this is no longer under the AICPA, what is now the AICPA. Instead, it's a board within a private organization known as the Financial Accounting Foundation. They're a private board, they're non-governmental, but they're not at least directly associated with the AICPA. They tried to put some distance there, tried to get away from that self-regulation, so to speak, and certainly create more independence for trust purposes. Appearance of trust, appearance of independence. So I threw out the term earlier, GAAP, Generally Accepted Accounting Principles. By the way, I have the FASB.org website. You can certainly find more information about them. But GAAP is just a general term we give for rules of accounting. That's kind of the term we use. You'll hear that all the time, GAAP. Now, the types of GAAP we have from the FASB. We have the very broad statements of financial accounting concepts, and then we have the more detailed statements on financial accounting standards. Now, again, we have all these different entities over time that have created GAAP, and there are other non-authoritative sources as well. But in 2009, the thought here was that we need to clean this up. We have a lot of mess out there, a lot of old stuff. Nobody really knows what's the best GAAP to use. So there was a project called the FASB Accounting Standards Codification Project, the ASC, and this basically cleaned everything up, rolled everything up under a new numbering system, and this superseded everything. Anything that existed prior to this doesn't matter. A lot of it was still adopted into the new GAAP, but it was reorganized, relabeled, updated. So ASC, you'll see that term when you're talking about the rules, but you'll also see the term ASU, Accounting Standards Update. So this is how GAAP is issued now. This is the only official form of GAAP that comes from this codification. Now, as of 2023, there have been over 150 of these issued, And again, they're pretty active, so it'll be interesting to see what happens in the near future. But now let's go worldwide. So we've been talking about the United States up to this point. The International Accounting Standards Board has been in place for quite some time. Now, what I want to mention here is that prior to this, the U.S. had their standards. There were quite a few countries that followed U.S. standards, but a lot of other countries had their own standards. The thought is that as you go to a global economy, investors are looking to compare companies across national borders. And that's very hard to do when they're using different sets of accounting standards. So the idea of international accounting standards was to make sure everybody was measuring information the same way so that an investor can easily make comparisons. So there's a good goal. By the way, a couple of acronyms here. IASB is kind of like the FASB, only international. IFRS is International Financial Reporting Standards. So it's all related, but they create IFRS, just like the U.S. creates GAAP, U.S. GAAP. The goal here, the FASB and the IASB worked together for quite some time to try to harmonize or converge the accounting standards. Now, I want to mention here that at this point, virtually all other countries except for the United States either require or allow IASB or IFRS to be used. Just like the metric system, the United States is the one major holdout for this, so we do not use this right now. And as we'll see here, it doesn't look like there are any near future plans to do that. But the point here is that there was a goal between the two boards to try to converge accounting standards. One thing I want to mention here is that the FASB is more rules-based. In other words, we set very specific, detailed rules for everything, as many things as we can. The IASB sets very broad principles-based requirements, and it leaves a lot more up to the auditor and to the company for judgment. Now, this convergence really started moving in 2001 and 2002. And the question at the time was, would the U.S. ever allow or even mandate IFRS? And again, that took over the 2000s and the early part of the 2010s. In July 2012, the SEC report on this, the board that was working with this, with the international standards, issued a final report and basically said there's no recommendation for us to ever do this. So at that point, July 2012, they essentially took it off the table, or at least put it on the very, very far back burner. In July 2015, there was another SEC statement that no recommendation would be made again. There hasn't really been a whole lot of movement since then. There were a lot of changes during the convergence project. There were a lot of things that got cleaned up. We got a lot closer to international accounting standards on some things. But then you look at other things. One that pops to mind would be the use of LIFO, last in, first out, for inventory. Now, you may or may not know what that is depending on what other courses you've taken yet, but that's one that the U.S. has made absolutely no movement on, and the IASB flat out does not allow it. The U.S. does. So the point here is that there really hasn't been a whole lot of movement since 2015, so it's one of those things we'll just have to wait and see what happens. And the last slide I had here is switching gears to the auditing standards. So auditors review the accountants. They provide an opinion on whether the financial accounting statements are prepared in accordance with the with GAAP, the rules in place. So as far as who sets the auditing standards, we have the Auditing Standards Board. Now, guess what? This is an arm of the AICPA, which brings up those same self-regulation issues we talked about earlier. One could argue this might be even a worse self-regulation issue because these are the auditors that we are placing our trust in to review the accountants and the companies. So there's a big concern of independence. That's always a major concern with auditing. Are the auditors independent from the accountants and the company that they're auditing? And is there the appearance of independence? So for years and years, decades, this was held to be acceptable. The thought was that these are professionals. We should be able to trust them. They understand that their trust is so important to us, so we'll let them be. Problem is, around the end of the 90s and early 2000s, you started to see a lot of big companies like Enron, WorldCom, Tyco. There were a string of them that had financial accounting fraud, financial accounting scandals. And the problem is the auditors weren't catching it. Some very big audit firms were not catching it. So for the same reason as we talked about in 1932 with the accounting standards, there was a big concern that investors were going to pull out investments, stop investing, or at least significantly slow it down, which would freeze the credit markets and hurt companies, hurt the economy. So there was a big piece of legislation passed, most commonly referred to as the Sarbanes-Oxley Act of 2002. And again, there were a lot of provisions. This video is not going through all the details of these at this point, but one of the provisions that is applicable right now was the creation and development of the Public Company Accounting Oversight Board, the PCAOB. Basically, this is a situation where the SEC is stepping in saying, we're taking control of the auditing side, and instead of letting the AICPA and the accountants self-regulate themselves, we are setting a board that will do it for them. But as the first two words of the name imply, this only can apply to public companies. In other words, those that trade on the stock market, because those are the ones that the SEC really has control over. They regulate the stock market. So the PCAOB is a separate board that sets auditing standards. Now the thing is, they're not starting from scratch. They are using many of the rules that were in place before with the Auditing Standards Board, and they still work with them. I mean, they're both professional groups. The big difference here is the PCAOB, if they disagree with the Auditing Standards Board, they can set their own rules that apply to public companies. So again, this is just a very brief discussion of some of these rules, and a later video on the Sarbanes-Oxley Act itself goes into much more detail on this. And that takes us to the end of our video, but before we leave, I just wanted to mention I have many other videos out there on a variety of topics. You can search them by going to my YouTube channel or by just typing in Severson Accounting YouTube. I do also have a link of videos in an Excel spreadsheet format, and I'll post that link to this video so you can see it from there. But hopefully this information has helped. Thank you for your time and have a great day.